or doing a different income method of the 10 that are discussed in the blueprint. This is what's possible. We took an RPM that had a 7% risk. Stock moved up as we expected. We used one of the income methods to almost bulletproof the position. And now we're in a situation where we can roll this and still make 90% of what we expected to make and still move on forward. Barry wants to know, how long do you wait? Well, it depends on what I'm doing, and it depends on what I'm looking for. Not trying to dodge the question, Barry. There is some discussion in the blueprint on that. But silver wheaton was more of an income generating. I follow this stock on a regular basis, so I look for the swings and the low points based on how I've been tracking it over the past 2.5 years, kind of moving in and out, protected positions. And this is what I was actually hoping would happen and I could achieve. I was hoping to do it in a 45-day time period. As you saw, I opened silver wheaton on 5/21, saw the gain that I wanted by 6/28. If by 45 days silver wheaton had not done what I wanted to, I might have used one of the income methods to adjust the position maybe on the downside or do a neutral adjustment to generate some income. Really, I'm hoping to see a move in these situations in 45 days. But this leads me into a perfect segue into what I wanted to talk about next. And what I want to do is go back to our slideshow presentation. Oh, let me maneuver this as well. Okay. Now, I want to discuss income method number 4. Income method number 4, the reason why I want to discuss this, Barry, is what it leads to and what I'm doing now. Some of the other positions I have open, and I'm going to quickly review that. I'm going to try to go through this quickly because I know I'm really over time. Income method number 4, we look at an example for DIA that Kurt opened a couple of years ago. He originally, this doesn't format right, and I apologize for that, but he originally looked at DIA at $115, sorry about that, $115 per share. At the same time, he bought a January 07 119 put for 5 points. So his total investment was $120 here. Let me use this. This might help a little bit. It was $120, but he's guaranteed an exit at 119. So his total risk is only $1. Over here, it's a little bit better view. Total cost is $120. He's insured at 119, so we're only risking 1 point on this position. All right? Now, what happens? 25 days later, the stock moves up in price, and the stock went from $115 to $120 on 10/19. The 119 put option had moved from out of the in the money, to now out of the money. The stock's above it. So the price fell from $5 to $205. Now what's interesting about that is when he opened the position and paid $5 for the put option, $4 of that was intrinsic value and only $1 was time premium. Now that the put is out of the money and trading at 205, that 205 is all time premium. This takes advantage of that ATM bell curve. Okay? For the put to drop 295, the stock had to go up 5 points. So he still has a gain. Now what he wanted to do is look at income method number 4. And what he did is he sold to close his 119 put for 205 and saw an opportunity to buy a January 2008 128 strike put at 970. Now this is a debit. This is the only income method that's done at a debit. So he increased his investment amount by $765. Okay, but why would we want to do that? We make the trade, we adjust the put, sell to close our existing put, buy to open the second put. We had our original investment of $120. We add $765 back into it, and now our total investment is $127.65. But what did Kurt do? He adjusted it to the 128 put. So now he has a guaranteed gain of 35 cents. No matter what DIA does after this, he's guaranteed to get 35 cents. If it continues to move up, he has an unlimited upside profit potential. If it drops in price, he's guaranteed. He's bulletproof on the position. So even though he added $765 into his total investment, bought stock at 115, bought the 119 put at 5 points, total invested was 120. When the stock moved up, he swapped his 119 put. He sold to close. It got 205. Bought a further out in time higher strike put for 970. He increased his investment by 765, but now he's guaranteed a higher exit. Now, when Kurt did this, he was in this range here. This red area is when he applied this income method number 4, and as you can see, the stock continued to move up. This is exactly where he wanted to be. Now, there's some other income method 5 and 6, what Kurt refers to as the money nets, that he would have applied in here with the sudden spikes and the sudden dips. And of course, DIA pays a dividend. So that's what you look for with income method number 4. Now, why did I want to bring this up? I see there's some other questions, and I'm going to wrap this up quickly and then answer these questions, so please bear with me. There are many ways to trade this technique. We talked about trading RPMs on common stocks. We look for those in the PowerOptions search screen. We talked about trading RPMs on ETFs, or even the inverse ETFs if we're bearish. I can open a long inverse ETF and buy a long put, and if I'm bearish and the market's falling, my inverse ETFs are going to increase in price, and I can treat it as a bullish position. Or use your own trading style. What do I mean by that? During Saturday's presentation, the online seminar that Kurt and I were hosting, after the presentation, I had a customer email me and said, during the seminar, someone mentioned a trade on EPB. Now, I was looking at EPB. It came up in the search results that I was using for a dividend payment that was up in price. Now, the customer mentioned when I looked at the chain, there's little or no call premium for income. So why would I do this? Why would I enter a position that has little or no call options or little or no call premium to try to generate income? Well, EPB matched what I was looking for. On 7/20/2010, I ran a personal search on PowerOptions. I started off with the standard radioactive settings, IBD 100, less than 20% in the money. I wanted to have at least a 2% dividend. I was looking for a risk of less than 7%, and I was looking for a stock that had an ex-dividend date near to the opening price or earnings that were coming up in the near term. So one of the results that came up was EPB. It matched my specific risk threshold. I liked the chart. It had an annual 5% dividend. The ex-dividend date comes out on 7/28, so I own 7/20, I had 8 days left. And then the earnings are coming out, I should say, on 8/4. So I might get a little pop there, but I also wanted to get the dividend. Now, mentioning the dividend, EPB is a limited partnership. This means that it has specific specifications which are different from a standard stock or an ETF. If you're trading this in a cash account or a margin account, you might have extra tax implications and might need an extra tax form. Okay? I'm not making a suggestion or recommendation. I'm trading this in a retirement account, so I don't have to worry about that. But what was my response? Okay, there's still low income. There's still not a lot of premium on the calls, and I realized that. And this sort of goes back to what Barry was discussing about, what would I look for? What would I look for example, how long would I wait? Well, this is a different approach. When I do a dividend-paying stock like this, I don't have that time frame of 45 days where I'm looking to make an adjustment. My answer was, I'm not expecting to use income method number 1 at all on this trade. I might not even use income method number 6. My SIGA model, which is discussed in the blueprint for entering a stock or using the 10 different income methods, is that I'm bullish on EPB, and I wanted to get in before the ex-dividend date. My expectations, EPB is going to move up in price. I can't guarantee that, but that's my expectation, just like it was in the Silver Wheaton position. Silver Wheaton, by the way, doesn't pay a dividend. Okay, so I am looking to use income method number 4 that we just discussed on DIA to bulletproof with help from the dividends. So after I collect the dividend in August, if the stock moves up as I expected, I'm going to look for an income method number 4 opportunity to bulletproof. Now I still have between, let's say, end of August or September through March expiration for a bulletproof position where I can still collect the dividend and still apply 9 other income methods. My goal is a long-term hold for extended profit as opposed to income. So this is why I didn't look at the call premium when I was opening this RPM. I'm specifically never planning to use income method number 1 or income method number 6. I'm looking to bulletproof in the near term, maybe the next 60 to 65 days with income method number 4, maybe income method number 3, and be able to collect the dividend after that. So you can enter this, you can do these any way you want to. You can look for stocks that maybe have a high call premium if you wanted to try to generate income and you want to move kind of in and out of the positions quickly, or you can use it longer term. Use it on ETFs, for example. Use it on inverse ETFs. It's dynamic. Well, my original setup was this. On 7/20, I bought 100 shares of EPB at 31.02. Bought the March 35 put for 6.10. My total at risk is 5.7% or $2.12. That's what we were looking at. Now, the catchy sayings Kurt uses that we talked about with the problem with stop orders is we don't want to pick stocks. We want to pick stops. And we also don't want to time our trades. We want to trade time. The 3 principles of radioactive trading that we reviewed on Saturday and that are in the